Welcome back to part 2 of chapter 4, Equilibrium in the Money Market. The equilibrium condition is represented graphically. Money is measured on the horizontal axis and the interest rate is measured on the vertical axis. The demand for money MD drawn for a given level of nominal income is downward sloping since a higher interest rate implies lower demand for money. The supply of money is drawn as the vertical line denoted MS. The money supply equals M and is independent of the interest rate. Equilibrium occurs at point A and the equilibrium interest rate is given by I. Increase in nominal income. An increase in nominal income leads to an increase in the interest rate. Why? At the equilibrium point A, the money demand exceeds the money supply. The increase in the interest rate will make people want to hold more bonds and demand less money. This happens until equilibrium is restored. Increase in money supply. An increase in the supply of money leads to a decrease in the interest rate. Why? The decrease in the interest rate increases the demand for money, which now equal the high money supply. Bonds are less desirable because of lower interest rate and more people hold money. The opportunity cost of holding money is lower. So you can also practice what happens if nominal income decreases as well as what happens when money supply decreases. So just a recap, money demand has a negative relationship with interest rate and money supply is determined by the central bank. How does the central bank change the money supply? So how does the central bank change the money supply? They do it through open market transactions. Open market transactions are transactions where the central bank buys and sells bonds. For example, if a central bank wants to increase the amount of money in the economy, it buys bonds and pays for them by creating money. Functions of the Reserve Bank. Note that these functions are not in your textbooks. So they issue banknotes and coins, banker to the government, custodian of other banks' cash reserves, clearer of interbank claims, custodian of foreign reserves, bank of discount and lender of last resort, inflation targeting and monetary policy. Monetary policy. When looking at the monetary policy, there's three choices: free capital flows, monetary independence, and the fixed exchange rate. So South Africa's choice is to go with free capital flows and monetary independence, leaving out fixed exchange rate, since South Africa has a floating exchange rate. The United States' choice is also to go with free capital flows and monetary independence. However, Europe's choice is free capital flows and a fixed exchange rate, so they're losing out on monetary independence. Same goes for China. They choose to have free capital flows and a fixed exchange rate. Monetary policy and open market transactions. Increase in money supply. The central bank buys bonds and pays for them with money. So that is your expansionary open market operations. And then to decrease money supply, the central bank sells bonds and receives money for them. And that's your contractionary open market transactions. The balance sheet of the central bank. So the balance sheet of a bank or firm or individual is a list of its assets and liabilities at a point in time. The assets are the sum of what the bank owns and what is owed to it by others. The liabilities are what the bank owes to others. The assets of the central bank are the bonds it holds in its portfolio. Its liabilities is the stock of money in the economy. Open market transactions lead to equal changes in assets and liabilities. If the central bank buys, for instance, 10 million rand worth of bonds, the amount of bonds it holds is higher by 10 million rand, and so it is the amount of money in the economy. Such an operation is called the expansionary open market operation because the central bank increases or expands the supply of money. If the central bank sells 10 million rands worth of bonds, both the amount of bonds held by the central bank and the amount of money in the economy are lowered by 10 million rand. Such an operation is called a contractionary open market operation because the central bank decreases or contracts the supply of money. Bond prices and bond yields. Interest rates are not determined in bond markets, but bond prices are. Suppose bonds are for 1 year and the promise is to pay 10,000 rand at the end of the year. The theory of interest is equal to your future value, which is equal to the present value, times 1 plus the interest rate times time, or if RPB is equal to RPB, where the subscript B stands for bond, times 1 plus I. Interest rate on bond. To solve for I, when rearranging the FRPB, the future value, equal to the present value times 1 plus I equation, you will end up with the FRPB minus RPB divided by RPB is equal to I. Like we said, the interest rate is not determined in bond markets, but bond prices are. Let's look at an example. Suppose bonds are for 1 year and the promise is to pay 10,000 rand at the end of the year. So we said to calculate the interest rate, we used this formula. So let's say the price of the bond today, or the RPB, is equal to 9,900 rand. So to calculate the interest rate, you're going to say 10,000 rand minus 9,900 divided by 9,900 is equal to 1% and not 10%. And then if the price of the bond is 9,000 rand, you're going to say 10,000 rand minus 9,000 rand divided by 9,000 rand, and that is equal to 11.1% per year. So what we're seeing is that the higher the bond price, the lower the interest rate. Equilibrium in money market, expansionary open market operation. The central bank buys bonds, which decreases the supply of bonds in the bond market, which increases the demand for bonds, increasing the price. Note, see if you can draw a simple supply and demand graph for bonds. The increase in bond prices decreases the interest rate. The money supply increases and the interest rate decreases. So the bond market and expansionary open market operations. This figure shows the simple supply and demand graph we spoke about in the previous slide. Equilibrium in money supply. This figure shows the effects of an increase in the money supply on the interest rate. The initial equilibrium is at point A with interest rate I. An increase in money supply leads to a shift of the money supply curve to the right from MS to MS prime. The equilibrium moves down from A to A prime and the interest rate decreases from I to I prime.